But this company is a loan originator, and they basically give you a loan, particularly say like if you're buying a house and you need a mortgage, bang, they give you a loan, and then basically they sell it off and they earn a margin on that loan. So nice and simple business to understand, and the risk is not too high because they're not holding this loan. The risk for them is not making enough loans, right? But we've got a few articles that are, well, 2 articles to be precise, that probably gives you a bit of convincing that this company is in the right space of mind to be thinking about it right now. So the US market is booming, right? The number of Americans buying new homes spiked to a 14-year high. So 14-year high, that's really reassuring, right? Home prices are growing at the fastest pace since 1991. So not only are more homes being sold to basically a 14-year high, the pricing is actually higher, so it means these loans are actually bigger. So you're making more loans, and they're also bigger loans. So, and if that's really reassuring, right? If you're investing in a loan originator, right? So the US mortgage lenders just recorded their biggest quarter in 2 decades. So if anything that you get out of this article is literally this sentence here. They're making the most loans in two decades. 2 decades. That's a big period, right? And then not only that, lenders handed out a staggering 1.1 trillion in home loans in the past 3 months. So if we're waiting with anticipation that Rocket Companies is going to have a brilliant third quarter, I think this is the best basically evidence, because Rocket Companies is one of the large lenders in the US, and basically if we're to believe what's written here, Rocket Companies has done a stellar third quarter, and when they report those numbers, they're going to look amazing. But we're going to look at the guidance that they've actually given us. I don't know if they predicted that the market would be going this well based on those numbers, but even when I base it on their own guidance, their guidance is amazing itself based on the current pricing. We'll quickly review those charts right after I review one more article, and then we can go about doing that, right? So here we go. The housing market is on a sugar high. Home sales are soaring, but it is a good time to buy. Here's what the experts say. Alright, so sales of previously owned homes in the US rose 24.7% between June and July to a seasonal annual rate of 5.86 million. Not only did the percentage increase represent a record, but the sales volume was the highest the US has seen since 2006. So we're basing anything on these 2 articles. We're seeing more houses sold in basically this year than in the past 1 or 2 decades, right? So that's an incredibly good sign. When you look at companies and you don't actually get the statistics from the companies yet, you just look at the wider moat around this company, the wider environment, and then that's going to tell you so much about the company itself. And that's what you do when you research these companies. It's kind of like if you look at EV vehicles, you look at the wider sales around EV vehicles, and then that kind of gives you a really nice idea. And here we're looking at loans, and we're looking at housing basically, and here we're being told that more houses are being sold and more loans are being originated. So I think that bodes really well with Rocket companies. And the article continues to state some reasons. So interest rates remain near all-time lows. So basically it kind of seems like the interest rate's so low, it would just be, as they would put it right here, a no-brainer to basically take a loan and buy a house, because the interest rate you're paying is just so minuscule that it would kind of be ridiculous if you didn't consider buying assets, particularly when there's no other better way to put your money, right? So, it's one of those things, right? Low interest rates leads to asset prices rising, and the best way to preserve your money value is by investing in those assets. There aren't many homes for sale, so that's also one of the things as well. There is high demand because of those lower interest rates, and the market is not full of supply, so there's not that many homes for sale, and it's causing that equilibrium to be quite high when we're trying to meet between supply and demand, because there is a lot of demand right now. Competition is driving faster sales and higher prices. As we basically saw with the other article, we're seeing higher prices, we're seeing more loans, and it is great for business. Great for business. So we can go back to this company, and the history of this company is back in August they IPO'd at $18, went to a high above $30, and then recently came as low as $18, and then has come back up to around $20, which I think is an incredibly undervalued proposition for this company. Hence why I brought some shares myself, because I think by the time these guys report their third quarter, it is going to be pretty good, right? So I'm gonna go to those quarter 2 statistics, and then we'll go to those quarter 3 guidance. So I want you to remember that the current value of this whole company is $41 billion for the market capitalization. Alright, so second quarter results. Their closed loan origination value was $72 billion, and their gain on sale was 5.19%, though I will remind you, quarter 1 they got 3.25, and quarter 2 they got 3.23, so it sounds like their gain on sale is closer to 3% as being normal, and them getting 5.19% was actually above normal. So I wouldn't expect them to get those kind of margins in future quarters. But it just means they did really well for quarter 2, but obviously on those higher margins. And then it went to basically a net income of $3.4 billion, though there are some adjustments to be made, some one-offs. If we take those one-offs, we get a net income of $2.85 billion, and that's just for one quarter, right? One quarter. So remember, this valuation of this company is $41 billion, and in just one quarter, they made $2.85 billion. In just one quarter, right? And I've got 3 other quarters that they think they will perform just as well in. So that is a splendid result. And mind you, quarter 1 was $655 million in net profits. So quarter 2 jumped so much, and of course that higher percentage gain on sale did help quite a bit. So we're just reminded that they aren't likely to get those margins in the future. I would stick to the 3.25 or whatnot to just be a bit more conservative around my estimates. And obviously they were a lot better than a year ago when they just made 260 million. They basically made 10 times that in the quarter 2 result, which was pretty brilliant, right? Right, so now we can look at the third quarter result, and the third quarter result is pretty good. Not result, guidance. Why did I say result? I mean guidance. So third quarter outlook, they're expecting 93 and 98 billion, which would be incredible. So the net lock, not the net rate lock volume, and also for the closed loan volume of 82 and 85. So we look at these numbers. So net lock, net rate lock volume is 91 for Q2, and it's going to increase to about 93 to 98. So just slightly increase in that. Whereas loan origination volume goes from 72 to 82 and 85. So I think it's a really good result to build up on, particularly since Q2 was a massive jump on Q1, and given the recent articles that we've just read, they could potentially surpass those that guidance, though we should base our valuations and our views on the current numbers. And if they outperform those numbers, it's a bonus. To be honest, it's going to be a bonus. And the gain on sale of margins, they expect it to be around 4%. So 4% will still be pretty good, particularly when in the past they've just gotten above 3%. Not as good as quarter 2 when they're getting above 5%, but 4% margins is pretty good. So I would still expect them to be doing about 2.5 billion in net profit for the adjusted side, and I think it should be pretty good, right? So if we plus like quarter 2 and quarter 3 together, we would be looking at a net profit of like 5 billion itself, never mind the other quarters. And I'm going to remind you, this company is a $41 billion company. So if they were just to make 5 billion on net profit, at the current situation, that's a splendid return. It's a splendid return. I'm not going to... I don't think you are going to find companies with such a low PE in this environment. Of course, it was when they did the 2.8 billion in net profit, it was new to them because previously they'd only done a few hundred million, a couple of 100 million. Now they did several hundred, and then now they're right into billions. So I think the market wants to see some consistency before it rewards this company with a very high share price. Though at the current situation, the share price is just so low. That for me, I bought shares in it, and my views is that this company is really undervalued, but that's just my view. You may have a different view, of course, and that's how the market, interpret things, right? It's about meeting my view, meeting your view, and then we find a price equilibrium. I think I look at this and I go, 41 billion is awfully cheap for this type of company. I'm gonna buy more if it comes down in price, but I'm happy to hold my current position at this current price. But I think it's going to be a lot higher. I think it's going to be a lot higher, particularly after the third quarter. And yeah, I think they're going to perform really well based on the current housing market, the loans that they're putting through, and based on their quarter 3 guidance. There's just a lot to like about this company, and hopefully one day the market will realize. Unless the market's like, these things are temporary, we don't see it continuing, hence why we're not willing to give it a high valuation. But I don't think that's true for 1 minute. I think market was a bit skeptical around the housing, particularly when there was basically a big decline in housing because in the middle of the year no one was really buying, and then afterwards everyone was really buying, right? Everyone was really buying, and the numbers look good, and they're going to look better as they are. The one big surprise is the housing market doing really well. Even I thought housing pricing wouldn't do that well, because it kind of makes sense, right? We're in a recession, people have lost jobs, how are we going to pay for these loans? Apparently now people just know how to pay for their loans. Like cheaper interest rates have helped a lot, and people finding ways, because the housing stock available for sale is really low while the demand is really high, and basically it's led to a boom in the property market in a lot of parts of the world. A lot like the US, and there's so many different parts of the world where the housing price is just high. But of course we're focusing on the US because this company is based in the US, of course. I'm looking at this, and these guys are killing it. They are killing it. And not to mention this great paragraph, right? While I'm proud of our performance, I am more encouraged by the significant opportunity that remains in front of us as we continue to execute on our plan of achieving 25% market share by 2030. It is clear that our simple, client-focused digital approach is continuously and fundamentally disrupting the way of our industries do business. So I'm looking at a really innovative company. I'm looking at a company that has big aspirations, and they are disrupting the market. If you want to invest in a company, you invest in disruptors, companies that want to grow, and this company is showing all the right stuff, right? So I'm saying what's not to like about this company. Of course, you can post below and let me know if there's something you don't like about the company, because I may not be seeing it. I may be looking at these numbers and thinking they're just too good, right? The one thing is, when you get too involved in a company, you think everything about it is good. and sometimes those flaws do not appear right before the price drops and then reality hits, right? But here I don't think that's the case. Basically at this $20 mark you are paying an IPO pricing basically, for an improved performance, of course. Because usually people pay quarter on quarter. As the quarter improves, the share price improves, but this is different. Basically the pricing has come back down to when they reported quarter two, so you get the advantage of looking at quarter two, you get the guidance of quarter three, and you get the advantage of buying at a really good price. So that's why, I'm looking at this and I'm going, sure, I think it's going to be stellar when they record quarter three, but we'll have to see when it comes. And it won't be too far away, so we will look for it eagerly. But I think buying at this pricing is pretty good. I think it's pretty good. I don't think you can make a wrong step at this pricing. 41 billion for a company earning who knows how much profits, anywhere between 5 to 10 billion. That's incredible. Those numbers are pretty good, and particularly in a really disruptive year where we would expect loan originations to be lower, but no, they're actually higher. And since this company operates a digital platform, it also means they have an advantage over the traditional approach, and it also means they're killing it based on that, because while people are not going out to get these loans entirely, we've got a situation where we can do it digitally, and this is going to be a huge advantage over a lot of the traditional lenders, and hence it's going to really favor rocket companies because it's in the right space, right time, with the right technology, and I think it's going to do really well. Until then, if you've got any questions, post below. Any comments, post below. Until then, good luck investing anywhere. Let me know if this is a company you'll buy, or if it's not, let me know why. Until then, goodbye.